If you took all the stocks that traded for 20 years or more, which would have the highest returns? Yeah, Nvidia, along with some more usual suspects like Amazon and Netflix. But in fifth place, you'll find a company called Axon. In a little over 22 years, Axon has returned 45,000%, or about 31% per year annualized over 22 years. Want to know how? We'll get to that, but first a story. It was 2004 and GW had passed the Nano Act. Nanalyze was the 30,000th most popular website in the world, and life was good. Around that time, we noticed that people couldn't stop talking about a stock called Taser. It was up something like 5,000% in a single year, and it certainly looked like hype, and it was. So 3 years later, the hype had died down. Hype always dies down unless it's accompanied by fundamentals. We did a presentation then when I was in B school on this stock as a group project, and I did my master's in the UK, and the Limeys were certainly impressed with the business. I think some even invested in shares. And 4 to 5 years later, that hype was all but gone, and the Limeys weren't happy about having their chains yanked. Get it? I was on my way over to Hong Kong to manage a new operation and to study for another master's. And while I was busy studying how to generate alpha, this happened. So between the time that I left my job in the UK until now, Taser, or what's now known as Axon International, returned over 10,000%. So some key takeaways here. Invest in companies, not stocks. So if you believed in Taser, the company, you would have just held through all this and would have still have been holding. And of course, that would leave you wondering just how much growth is left for Axon. So let's start by seeing if the fundamentals justified the price appreciation. So when we look at Axon's revenue growth, so if they're disrupting, then revenue growth is a proxy for market share captured, and indeed they are. So you have a 15-year compound annual growth rate for revenues of nearly 20%. And here you can see their estimated revenues for this year. They're still on that same trajectory. But when we look at what they do then, what exactly are they selling? At a glance, they're selling tasers, and you should all be familiar with those by now. They're certainly featured enough in the media. They're also offering this Axon Cloud, and then what they describe as sensors and other. And I think this revenue breakdown here does a pretty good job of starting to segment things. So you can see the three buckets. You have cloud and services, sensors, and Taser. And along the bottom there we see annualized recurring revenues. That's quite interesting, and we're going to take a closer look at that. But if you dig into their latest 10K, you'll see a much more granular segmentation, and then you can start to make observations about what's working for them and what's not. So, for example, you see the growth there of fleet systems. So it's probably a new offering, and they're probably doing quite well with that. So when we consider growth, all revenue growth is not the same because some businesses are more profitable than others. A few observations here. So first of all, they've segmented their revenues by those three buckets that we described earlier, and you can look at the growth rates over time. So what's more interesting here is you see the revenue growth and gross margin. So as one would expect, Axon Cloud and Services is a very profitable business. And whenever we are investing in hardware businesses, we always want to make sure that the firm is supplementing hardware with some recurring revenues that will lead to high margins, as you're seeing here, because hardware will always be facing pricing pressure. So it's great to see that they have that cloud offering that's helping to boost their margins. That's excellent. And when we look at gross margins over time, here you can see those plotted along the top. So they seem to be staying consistently around 60%. That's quite healthy. Then you have your operating margin there along the bottom. So what we're really more interested in would be looking at cash flows. So business that's growing is expected to be spending lots of money, but if they have positive operating cash flows, that means they don't need to go raising money by either diluting shareholders or taking on existing debt. Speaking of which, this is a $33 billion company with just $710 million in debt, so that's not a huge deal. But along the bottom here of this table, you can see cash flow from operating activities there, quite healthy over time, which leads us to this slide in their deck, which is quite telling. So what they're pointing to is something called the Rule of 40. And what that means is we did an entire presentation on the Rule of 40, and McKinsey had a piece that delved into it in quite a bit of detail. So they say the purest test of a management team and its operational discipline is how well it can maintain strong shareholder returns as the business matures. So the Rule of 40 simply says this: take a company's growth rate, add that to its free cash flow rate, and that should equal 40% or higher. And of course, Axon is showing us that they're exceeding the Rule of 40, and also that's improving over time. And what's interesting is that investors reward companies that are at or above the Rule of 40 with consistently higher valuation multiples, and Axon is no different. Their current valuation, we can calculate that using what's called our simple valuation ratio. We just take market cap and divide that by annualized revenue. So their market cap's $33 billion. Last quarter revenue's $504 million. You multiply that by 4 to annualize it. You divide it all out, and you get 16. That's relatively high compared to our catalog average of 6. And the question I think that investors will have is, can Axon continue growing? Before we talk about that, I wanted to give a shout out to Bicep Monkey for his contributions to this deck. So we have a great community on Discord. This is where all our paying subscribers get together and share some banter. And this gentleman was kind enough to assist me in putting together this deck, and that's much appreciated. If you want to join us on Discord, just become a paying subscriber and we'll invite you to the server. So when we look at Taser, I think it's worth mentioning they have an exceptional founder. If that isn't evident from the financial performance of the firm, then you can look at his bio. Rather interesting. He founded the company in a Tucson garage in 1993 after 2 of his friends were shot and killed. Now, originally, as I said, this was known as Taser International, and now it's Axon. Their mission is to protect life, they say, which involves making bullets obsolete. Now, Rick's family bet everything they had to get his company off the ground, and it nearly drove his parents to financial insolvency. And they were only saved when Taser had their IPO in 2001. And they talk about their mission being to cut gun-related deaths between police and public by 50% in 10 years. And when we dig into the business itself, it's not just hardware, as I said. Look at this. They're measuring net retention, and that's healthy. That's about where you want to see your net retention rate. These days, of course, it's slipping for a lot of firms, but 122% is great. They have long contracts. They say 5+ year customer contracts. That's great. You're locking your customer in. And when you look at this chart here, it shows the annual recurring revenue growth over time. And of course, that can be a classification exercise. But the fact that they've been able to, they say here, total revenue from customers tied to subscriptions at 95% last year. That's rather impressive. And this spreadsheet here shows the sort of 5-year pricing model that they might use. There's a 4% annual inflation adjustment in there, and they talk about their hardware revenue recurs every 5 years. That's pretty good, right? And of course, there's consumables. That in that previous breakdown we looked at in the 10K, you can see what sort of consumables revenues they're getting. But they also talk about VR hardware revenue, and what they're doing there is using VR to train officers, of course, to reduce deaths. Over 90% of cash flows are recurring for these contracts. So that's very appealing when you think about the company's value proposition. The technology platform they have is transforming public safety. To talk about cloud-powered integrated hardware and software for public safety, spending of which continues to grow. They estimate the total addressable market at $77 billion. And this is a great chart. They break it all down. They say, all right, where would this $77 billion be coming from? And you can pause this and take a look for yourself. But I liked this piece here showing penetration and global expansion. So you can see they're primarily operating in the U.S. They seem to have made some progress in the Commonwealth there, but then when you look at their international revenues breakdown, no single country accounts for more than 10% of total revenues, except, of course, for the United States. That's something worth noting. Now, when it comes to growth opportunities, they've highlighted a few things here of interest. So you've got cross-selling and upselling, emerging products, Axon Air. That's very interesting, right? Drone defense. and of course the VR training I mentioned before, and then they look at these emerging verticals, enterprise, federal justice, fire, corrections, and as I said, that global expansion opportunity. But along the bottom, you see M&A activity. And when you look at firms they might acquire, I was thinking there's a company called ShotSpotter that might be a good fit for them. Be curious to see the synergies between these two firms. But what's looking up for Axon is the fact that the United States public safety spending isn't likely to dip very much. So we certainly have a change of guard coming up for whatever administration happens to win the coming U.S. election, and it's likely that public safety spending will continue regardless of whether the incumbent party stays in power or not. So just some closing thoughts here. When it comes to investing, always invest in companies, not stocks. I think the story that we told at the beginning of this presentation really spelled that out. Fundamentals need to match the stock performance eventually, right? In some cases, you'll see valuations get wildly ahead of where they should be, and then the fundamentals catch up. NVIDIA is a great example of that happening. Now, if they don't, it's hype. And guess what? Hype evaporates over time. Axon has a large potential TAM to fuel continued growth. And I think acquiring adjacent offerings seems to make a lot of sense for the company. But as I said, be very wary of valuation there when you're considering possibly investing in this firm. They're up 121% year to date versus a Nasdaq return of 48%. That's rather remarkable, right? Nasdaq's already returned 48%. All you had to do is invest in that benchmark and you would have nearly increased your money by 50%. So I'm going to go ahead and leave you with another video here that you might find interesting. This one's on investing in defense stocks. There's actually an ETF out there that holds Axon as a defense stock, so give that a watch. Thanks so much for taking the time to watch this today.